Welcome to the daily update, where I'll go over the action in the market from Monday, October 7th, and then we'll see how things look for Tuesday, October 8th. Well, after Friday, we were leaning back a little bit more positive because we had, especially near the end of the day, a nice little up move, and that was helping some of our indicators. Well, after Monday, we're now shifting back and looking a little bit more negative. Now, we're still positive, and I measure that by being above the 20 period moving average in the short term, the 50 in the intermediate term, and the 200-day moving average in the long term. But some of our other indicators are looking a little bit weaker right now. We're still wondering, is this Hindenburg Omen going to turn into anything? Is the weak seasonality going to develop into anything? We do have an escalation of things in the Middle East, and so that's driving oil higher. We also have the 10-year yield going back above 4%, and the stock market is starting to notice that. It didn't really play into things on Friday, but it did play into things on Monday. So we're just kind of chopping sideways over the last few weeks. We've been not really trending all that much, not really breaking out, but not really breaking down either. Before I get started, I have a thing called the SPX Investing Program. It's up, it's going, it's free until the end of 2024. There are additional videos that I post there. You have more access to me, and we can set up a time on Zoom or Skype to talk about things. There's a link that will take you to the website below this video. Also, a link that'll take you to a video that talks more about the program. If you have any questions, you can email me. And one of the benefits is you get immediate access to the daily and weekly videos as soon as they are prepared. Also, over the weekend, I did the outside videos here. These are all weekly videos. Well, inside is the daily video, and that's the real foundation of the analysis that I do. Okay, so right at the open, we had a lower open. Futures were drifting down a bit, and we chopped above and below the daily pivot at 57.36. Then we finally broke lower. We could have broken higher, but we ended up breaking lower, and we declined below S1 at 57.18. Then we came down to that 5,700 level and actually dropped below it, and we ended up closing below 5,700. We were down 0.96% on below average volume. So even on Friday, when we had at least near the end of the day, that up move after the employment situation report came out, that was a below average volume day. And then we have a down day on Monday, that's below average. It's just showing a lack of conviction right now as the market has really just been chopping sideways. We are still positive in the short, intermediate, and long term as measured by the moving averages. What concerns stocks on Monday is that we're back above 4% with the 10-year yield. Inflation seems to be under control, but we're going to be getting CPI later in the week as well. That's the big inflation report that the market fixates on. And the geopolitical things that are happening. It's the anniversary of the October 7th attacks that happened. And you've got a lot of really important days coming up in Israel. It's like their holidays or their feast days now. They've been attacked during this time before. We're wondering if something's going to happen there. There is an escalation going on because even though Hamas and Hezbollah have been acting on the part of Iran, it's now becoming more of a direct confrontation between Israel and Iran itself. So that could turn things even more negative or ugly than they've already become. Some comments. We're back above 4% with the 10-year yield. We're back below 5,700 with the S&P. Mega caps and semis underperformed, where on Friday they outperformed. On Monday, there was no follow through to that. And then this escalation that's happening in the Middle East, and this is getting oil up above $77, where not so long ago it was in the mid 60s. On a short-term basis, we're still looking extreme with the slope oscillator, even though it's coming down and it's fallen below its moving average, and the stochastics are still extreme. And then with things moving above 20 with the VIX, and I measure this using an RSI based on 9 periods, we're now getting extreme with that reading since we really shot up in Monday's session. And the Stoch RSI is already looking rather extreme. In the intermediate term, we still have the PMO studies, which could be taken as positive, the one chart that I'll show you just shows the rest of the S&P with PMOs that are still above zero. And the bullish percent index, which is now declining, but it's also still giving us an extreme reading to the upside there. And the 10-day new highs, new lows for the S&P coming down a little bit, but still looking extreme. And I'll show charts of all of these things. And we're still looking, again, positive from a longer term basis, but we're looking rather extreme with the 150 and 200-day simple moving averages of the S&P 500. The scenario has not changed. We'll see if it's going to change with CPI coming out later this week. They did cut rates 0.5% because as of right now, it seems like this soft landing scenario is quite possible. That means that we will not go into a recession, but that can always change. The dollar was up and interest rates were up. We closed at 4.03% with the 10-year yield, where after Friday we were at 3.98%. And both of these together, the dollar really bouncing last week, that could put some pressure on stocks as well, since stocks prefer a cheaper dollar or a lower dollar. It makes the conversion rates more friendly and the import-export relationships more friendly. So stocks like that. The 10 to the 3-month yield curve is still inverted, where the 10 to the 2 is still uninverted for right now. It's getting kind of close with that 10 to the 2 year. We're going to have to see if that's going to end up going back inverted again. But so far, it has not. Sentiment is still positive. We were getting up close to that 75 area. That's the extreme positive reading. Well, with the down day, we ticked down to 70. So we're still positive, but now the context has changed a little bit because we were coming down from a higher reading. We'll want to see if that's going to continue. And we're still positive with our trend. The green line is still above the red line, but we're in a weakening trending environment because the ADX has dropped below its moving average, but it's still above 20. And again, I'll show you the chart of this. With the down day, the bias is negative, and our momentum, I'm still keeping it mixed for right now because we're just chopping along. The only economic report that came out was consumer credit. It came in up 8.9 billion, less than the 12.7 billion that they had expected, and down quite a bit from the 26.7 billion we saw last time. And here's a chart showing how on a year-over-year basis, consumer credit is going up, even though it was down less on a month-over-month basis. Here is the month-over-month. So it was positive, but well off of the high reading that we saw last time. And then looking at the path of the S&P 500 price and earnings per share, this was as of last Thursday, put out by Goldman Sachs. Of course, when things are looking more positive, they have more rosy scenarios going forward. But what justifies stock prices going up is the earnings per share going up as well, because it's ultimately earnings that drive stock prices higher. And they think 3 months out we'll be at about 6,000 with the S&P, and a year from now we'll be at 6,300. And emerging markets, they're getting kind of enticing to some folks again. There may be some folks that like to get into those types of investments, and we're seeing the ratio between equities and in emerging markets and U.S. equities is very, very low. Now, we can still drop below this like we saw way back in the 50s. Of course, all you remember when that happened. But we're getting down to a -1 standard deviation here. And sometimes that could bring in some investors who want to get into emerging markets to see if they can outperform U.S. stocks. Then the 10-year futures, the speculative net positions are actually going short right now, which could end up being positive because when you have a lot of people drifting one way or the other, the market will often have a tendency to do the opposite of that. But for right now, they're going in the right or the same direction that the 10-year yield is actually, it's actually going, the yield's going up, but this is the price of the 10-year itself. So they're actually in the right direction for right now. Then what are the returns after the first interest rate cut? And again, it's the context. You can look at a chart, you can go back 50 times over the last 100 years or whatever and say, when this happened, this always happened. Well, we have to remember the context because it's not always a cut and dry scenario. For right now, anyway, the Fed is cutting rates because the economy is holding up, inflation's coming down, and they want to try to stimulate the economy to have a little bit more growth. But at any time, that could change if we have a black swan event, if something really catastrophic happens, and the Fed comes in and cuts rates for that reason, that changes the whole context. And yes, stocks will be negative at that point. So we want to keep an idea in the back of our mind, why is the Fed coming in and cutting rates? And this is kind of a weird looking chart here. Looks like something from the movie Frozen with these different colors. But it says earnings drove about half of the returns in the S&P 500 over the last year. And the earnings are the dark blue. And they're driving prices higher. Where multiples, this is the PE ratio looking forward, the 10, 15, 20 scale that we use. Sometimes what drives prices higher is that they're considered to be inexpensive or cheap or fairly priced. Well, what's been happening over the last year is that it's earnings that are really driving stock prices up. And then what are people getting into right now, according to Bank of America here? They're getting into real estate investment trusts. Okay, even though real estate got hit pretty hard last week as interest rates are going back up, the financials are still looking pretty strong. Now, utilities got hit on Monday, but they've been doing quite well lately. And then we're seeing a lot of money coming out of the low volatility stocks. Now, I go over that in the weekend video. When you look at the low volatility ETF all by itself, it's looking really good, but it's underperforming when you compare it to the S&P 500. And then since we had the employment situation report, we get this chart updated as well. This is all employees and temporary help services, where we're still below this red line. Now, typically what will happen is when we drop below this red line, these darker areas here, that means we've gone into a recession. But that hasn't happened this time. And now the red line's going back up, but it's still the thinner red line is here. But it's going up, but we're still below this thick flat line right here. If we can get back above that, that would actually suggest things are improving without going into a recession. So even though this works most of the time, it doesn't necessarily mean that we're going to go into a recession right now. But again, as with everything, that could change. And then looking at the forward 12 months PE ratio multiple, where you have the actual, which is the blue line, and then Goldman Sachs has their model here. They're not seeing where things are overvalued at this point, where if you look at the 10, 15, 20 scale and just use those static numbers, we're getting up well above 20, even with the forward PE ratio, and that means stocks are expensive. I did find one chart here. Really, it wasn't on Twitter, but I wanted to include this. And a lot of folks are saying, well, should I get into small caps or mid caps? Well, you have to look at the context behind small caps and mid caps. And this just shows the small caps, mid caps, and large caps of the companies with negative earnings. 42%, according to the Russell 2000 small cap index. Those companies, they're not making profits. So there's a reason why their prices are lower. There's a reason why the index for the Russell 2000 and the small cap index that we follow hasn't been doing really well right now, because it's ultimately earnings that drive stock prices. Whereas you have 14% of the mid caps and even 6% of the S&P. But this is quite a large number for right now. And this is why for some folks, small caps are not attractive. Here's our intraday chart. We did have a lower open after we had that nice little run up on Friday, and then we just chopped along the pivot above and below, above and below. Finally, we broke lower. We dropped down below S1, didn't quite get down to S2, and now we're below that 5,700 level. We tried to bounce back up, and it looked like we were going to recapture 5,700 going into the close, but it just didn't quite work out that way. And not really an awful lot to show you other than look at the big picture here. Going back into like the middle of September, do you see how the intraday chart has pretty much just been floating sideways? And that's showing the real lack of conviction. Yeah, we have up times, down times, and so forth, but it's not really moving like it was earlier in September when we were really moving up. So this has been part of the frustrating factor to give us a consensus for are we going up or are we going down. That's why we're seeing a mixed picture right now, is because we're not really seeing any conviction behind the movement of price. And this is coming down with the red line and the blue line, but we're still not as happy when the red line is above the blue line. That means value is outperforming growth intraday. We want growth to outperform value. This is showing a little bit of improvement, but then it dropped off as we went into the close. When we look at S&P growth to value, we want this to keep going up to be more positive. If this continues to fall, that would justify becoming more negative. Our end of day chart where growth was down more than value, even though everything was red. And I like to point out from time to time, the middle area here, these are the ETFs. Like this is the SPY, this is the MDY. This is, I'm not sure if it's the IWM small cap ETF or if it's the SML, because I used to use SML all the time, but then they switched that all around and I got all messed up. But we were down more with growth with the large caps than we were with value, down a little bit less with the mid caps and down less with the small caps. So then we look at our end of day charts for the small caps, just not really showing any strength. A little bit of a tick up, but not any strength here with the mid caps. And we're still looking a little bit better, but we want to see this continue to go up when we look at S&P growth to value on an end of day basis. If we continue to go up, that would be more positive for the S&P. If this rolls over and goes down, that'll be more negative. And we're not seeing much of an improvement here. When we look at the growth versus value ETF, we're still dancing down around the 250-day moving average with the rainbow. But this is still encouraging. We're seeing discretionary really outperforming staples now. So that's a little bit better. And even though discretionary has been pulling back, staples were down and they've been going down. So we're seeing some improvement with discretionary, but it's more the weakness that we're seeing right now in staples that is causing this ratio to go up. Large cap growth still above all the plotted moving averages here. So that's still hanging in there. And here's our trend. We're flat now. We're trending because we're above 20 with the blue line, but we're not above or really below the moving average. But we still default to positive because the green line is above the red line, but the green line is coming down. Short term, also not really able to get above the moving average, but the green line is still above the red line. And we're continuing to drop off with volume as there's a real lack of conviction here. This is a weekly chart that we get. It's more of an aggregate of different sentiment gauges together. This is kind of lining up with what we're seeing right now, where we came in at 74 after Friday. This was before Monday's open, so we're kind of getting extreme here. But we're coming in right now at 81.53, which is suggesting that folks are a little bit too positive about things right now, according to this chart. And the VIX is now back above 20, both with the line chart and the bar chart, and that's when we typically will see negative annualized returns. And when the VIX goes up, the VIX of the VIX also goes up, showing an increase in fear. Here is the RSI based on 9 periods, where we're just barely starting to show that the VIX has been going up pretty fast as it's climbing back above 20. And the momentum of the VIX is also up now, as measured by the MACD. And so we're possibly coming into this time here when we look at the seasonal tendencies of the VIX right now, which is to go up, which could put some pressure on stocks. The skew index is still giving us an extreme reading. This is a variation of the VIX. We're still in this area where the market's expecting some kind of a big move. And until we drop out of here, we don't know if that's going to be an upward move or a downward move. It's just that the market thinks some kind of a move is on the way. So we ticked up with this fear gauge and we ticked up just a little bit. It's hard to see here with this other fear gauge. So fear is starting to increase in the market, which could be negative for stocks. We saw a little bit of an improvement with the risk on to risk off ratio. And it's not so much that the high beta stocks did well, it's that the equal weight was under a little bit more pressure in Monday's session. And we came back up a little bit here with the daily chart of the equity put call ratio. We're still going down with the 5-day, but we're starting to turn back up with the 10-day. So we're getting a little bit of contradiction there. And the volatility risk premium starting to increase as fear is coming back into the market. The advanced decline line, we did come down based on price and volume, but still holding up above these advancing moving averages. And we saw more new highs than we saw last Friday, but our 5 days going sideways, and we're still declining here with our 10-day. But internally, we're still looking pretty good for right now. And the accumulation distribution did come down, but we're still above an advancing moving average and not necessarily getting an extreme reading. So this is still positive, even though it declined a little bit. In the short term, we're starting to drop below zero with our advanced decline ratio based on 19 periods. So we're dropping below zero based on price. We're still above zero based on volume. And we came down a little bit with the Chaikin money flow, another smart money indicator. But the red line is still continuing to go up. And we actually declined here with the Chaikin oscillator. So we're seeing a little bit of a mixed picture here now. The vortex did decline, even though the green line is above the red line. Looking at the S&P 500 cumulative advanced decline line based on price, didn't really move all that much. And we're holding up fairly well when we look at this based on volume. So we're not necessarily falling apart. We're just seeing weakness that could be starting to enter into the market. Now, if we have an up day, some of that weakness will go away. We're still looking extreme positive with the 10-day average of the S&P 500 highs minus the lows, and the 50-period moving average of the highs minus the lows is now still rolling over just a little bit here. That's the negative side. The positive side is we're still above zero. And here's the daily score for the S&P 500 highs minus the lows and the 50-period moving average. I just put them together on this chart. We're still looking okay here with the S&P and comparing it to the NYSE advanced decline line. So we came down a little bit with the cumulative advanced decline line for the NYSE, also declined a little bit, but not really falling apart with our regular NYSE advanced decline line, and a bit of a decline here with our other NYSE advanced decline line. When we break this out based on common stock, we saw a bit of a decline, but not as much of a decline based on volume. And that could be encouraging for the market to see volume holding up better than price. Here's the daily score. We're still above zero with the new highs, new lows for the NYSE. Here's the 50-day moving average here, where it's still having a tendency to go up, but it's slowing down quite a bit right now. And then another broad market measure of a 5-period moving average of the highs minus the lows. We're coming down, but we're still above zero. We look at large cap versus small cap ratio. We actually declined a little bit. We've just been chopping around lately. There's been no real conviction here. And we are coming down a bit with the advanced decline line studies, but we're still above the moving averages with all the indexes that we follow. We're actually dropping below 50 with those stocks in the S&P above their 20-period moving averages. So that's turning things in the short term a little more negative. We're declining but still positive with those stocks above their 50-day moving average, declining but positive with the 100 as well as the 200-day simple moving average study. And nothing really much to show here. We've just been kind of blobbing sideways here, but we're still above the 50-day moving average. The concern that I'm seeing is that we continue to be below average when we look at volume. So we're declining with the 20, 50, and we're no longer extreme positive with the 200-period moving average study of the S&P. We're already extreme negative with the Stochk RSI. The Williams percent R is declining, but still above the midpoint. And we're declining a little bit below the midpoint with the CCI 14. We're still above the midpoint with the CCI 20. And we're coming down after being extreme here with the short-term stochastic. We're starting to decline, but not extreme with the intermediate term. We're declining below the moving average, but still extreme positive with the long-term stochastic. And this is just a further subdivision of the short-term time frame. We've actually dropped a little bit negative here with the force index as we went below zero. The condition of the short-term trend, the 20-period moving average here, we're still below these lines, and this is causing the green line to potentially start to crawl underneath the blue line here, which could show a weakening of the short-term trend. But when you look at the simple and exponential moving averages based on 20 periods, we're still above both. We have not been able, or we have not closed above those. That's why we're still positive for right now. And we're still above the midpoint here with our standard deviations chart. So that's hanging on to being slightly positive. We're negative with the balance of power. We drop below the midpoint and we're continuing to decline. Here's the condition of the 50-period moving average, where we're starting to drop below both of these lines now, but we're still above all the plotted moving averages here. The go, no go, which redrew, it actually went more neutral with the lighter shade of blue. Now it switched back to the darker blue, which is more positive. And we're still above the midpoint with the highest high value chart. The TTM squeeze is no longer extreme positive, but it is declining since it's coming down and it's darker blue. And this is just a longer term look at that same chart to give it a little bit more context. We're declining, but still positive with the ease of movement. The Arun indicator is still positive, but it's flat right now. And we're getting pretty extreme here with the S&P McClellan oscillator. We dropped below zero, and we're getting down to a pretty negative reading right now. So that's causing the summation index based on price and volume to continue to decline. And we're also declining, but not necessarily extreme with the NYSE McClellan oscillator. So the summation index for the NYSE is now declining based on price, but rolling over, but not as intense based on volume. We've turned more decidedly negative here with the Swenlin trading oscillator. We're declining below zero and we've dropped below zero based on volume. We had already dropped below zero based on price. And momentum is starting to show some weakness too. We're rolling over with the PMO. We're already negative based on price. We're declining, but still pretty much on top of the moving average based on volume. So we're coming down just a little bit here with the PMOs that are rising. The buy signals are declining. This is what is still extreme positive and could be taken as positive. These are the PMOs that are above zero inside of the S&P, and they've been holding on to a pretty high reading right now. We've gone from positive to negative with the Elder's Impulse system for the S&P. We're negative with the parabolic SAR since the dots are on top. And even though we're above this green line, we're still extreme positive. The slope oscillator continues to decline below its moving average. Also the MACD, which is more short to slightly intermediate term, it's starting to cross below its moving average. So we're seeing more weakness in the short term, intermediate term. We're rolling over but haven't crossed over negative with the long-term oscillators. And we're no longer extreme here with the Sean trend meter since it declined. And now we're starting to come down again. Now, on one hand, you could say, look at the bullish percent index. We're at 77. That's a very high reading. But the context is, after Friday, it went back up. But now the context has changed back over to it's going down. And you can see other times when we had really high readings and what happened with the S&P after that. We're still looking pretty solid here with the NYSE bullish percent index. It declined a little bit, but it's not coming down all that strong right now. And we declined a little bit, but still looking positive with the NASDAQ 100 bullish percent index. We're declining, but above 50 with the money flow, declining, but above 50 with the ultimate oscillator. And this also shows how we've been chopping sideways. This is on balance volume. It's just jiggling up and down right now. We're crossing over and actually turning negative with the Copic curve, another momentum oscillator. We're declining with the RSI 14 and 9, but we're still above 50. And we want to keep an eye on this 20-period simple moving average of the open, high, low, close. We've been able to stay above this mini rainbow for right now. That could be providing some support. If we start to drop down below that, that could turn things more negative, especially in the short term. Long term, though, we're still looking pretty good. We're well above this R2 level with the weekly chart of the S&P. But we're looking more negative now with the Heiken Ashi with the black candles. We're positive but pointing down with the Kigge chart, but we're still positive with the Renko chart, but we're turning a little more negative with the through-line break chart. And we're still looking good even though we're coming down with the 150 and 200 period moving averages above these red lines. And we're switching over to negative in the short term for the small caps, but all of the other indexes are still positive on all different time frames. Bonds are negative in the short term based on price. Commodities are roaring back. A lot of that has to do with energy doing quite well. They're now positive in the short and intermediate term, but still negative in the long term. The dollar, after bouncing up last week, is positive in the short term, but negative in the intermediate and long term. And all of the different sectors were down except for energy, and that could be attributed to geopolitical angst going on there. All of the alerts that were triggered ended up being negative, where the NASDAQ was crossing below 18.1, then 18. We had the S&P below 5,700. Now, this is actually positive. The euro crosses below 110. That means the dollar is going up, or the euro is going down. Canada, which just recently set an all-time high, did see a bit of a drop off there as well. And discretionary, it's crossing back below 70. Now, this has been an area that's been showing some recent strength. We want that strength to continue if we're more positive. If this continues to show more weakness, that will naturally be more negative. And we're not really seeing much of a disconnect between the weighted version of the S&P and the equal weighted version right now. They both declined on Monday. Not much of a change here with our ratio as we've been chopping around more lately. The Dow, after setting an all-time high on Friday, was down 0.94%, going from positive to negative with the Elder's Impulse system. And we were down over 1% with the NASDAQ, but we're still above this pivot point and we're still above the 50-day moving average. Also, with the NASDAQ 100 down over 1%, still above this pivot point, still above the 50-day moving average there. And we've gone from positive to neutral with the QQQs with the Elder's Impulse system. The momentum is trying to cross over negative here. It's still pretty much on top of the moving average, but this is the PPO, which measures the momentum of the NASDAQ 100. That is starting to turn more negative. And small caps were down over 1%. They're still above this pivot point, still above their 50-day moving average. Then we look at the Russell 2000 small caps, right at the 50 level with the RSI, still above the 50-day moving average, but the momentum, as measured by the MACD, continues to be negative there. We've gone from positive to negative with the Elder's Impulse system for the small caps. Mid caps continue to chop sideways, still above this pivot level, still above its 50-day moving average. But we've gone from positive to neutral with the Elder's Impulse system for the mid caps. The Wilshire, coming off of a recent all-time high, was down 0.94%, still above its 50-day moving average. And also down was the total U.S. stock ETF, down 0.93%, but still not necessarily falling apart at this point. The staples to tech ratio is continuing to decline. It's not so much that we saw strength in tech, it's that we saw weakness in staples. That's causing this ratio to go down. That's positive for tech. But we've seen a recent golden cross here with this ratio, meaning that staples have been outperforming tech enough to generate that golden cross. The financial sector was down, but still looking pretty good for right now. The FANG index was also down 1.5%. Still has a ways to go to get back to its all-time high. Apple was down 2.25%, but still above its 50-day moving average. Amazon down over 3%. And this is a bit of a concern here. Microsoft down 1.5%, dropping below the 50 and 200-day moving average. If we stay below the 200-day moving average, we could see a death cross here. Meta was down 1.87% after recently setting an all-time high. Google's declined, but still above its 50-day moving average. Nvidia was up 2.25% above its 50-day moving average. Tesla was down 3.7%, but still above its 50-day moving average there. And Netflix down almost 2.5%, still above its 50-day moving average. So yeah, we saw some weakness, and there are things that we're concerned about, but we're not necessarily falling off a cliff, at least yet. When we look at the relationship between U.S. stocks and world stocks, the short-term relationship is falling off, where the longer-term relationship is still staying strong between the two. Oil is really starting to go back up. We're into the 77 range now. And the dollar continues to go up, even though on the chart here, it is in a downtrend. And we're really shooting back up with the 10-year yield. And when that's going up, the price for the 10-year ETF continues to go down. Not seeing much of a change here with the Qs to S&P growth to value ratios dropping below the moving average with discretionary to the S&P and right on the moving average when we compare large cap growth to large cap value. So not much of a change here with the large caps, a little bit above the moving average with the mid caps and coming a little bit above the moving average with the small caps. This ratio continues to go down when we look at S&P to utilities. We want this to go up, showing the S&P is outperforming. This is continuing, even though it popped up on Monday, overall, it's been continuing to go down. And this is kind of encouraging right now. The staples to S&P ratio, when this is declining, that tends to be positive for the S&P. And then we have this Hindenburg Omen. We don't have another confirmation, at least yet, but we did get the initial confirmation here. So we're just kind of keeping an eye to see if this is going to turn into anything. So what's our outlook for Tuesday? We are still positive, but weakness is now back to the point where it looks like it's building. Of course, we have a good update on Tuesday, could switch that all back around. We do have that confirmed Hindenburg Omen and weak seasonality, which to this point just hasn't really led to anything. We're going to get the NFIB small business optimism on Tuesday, as well as the trade balance. So not a big day. It'll be Wednesday when the big reports start to come out. And then just all the different geopolitical things, specifically in the Middle East. That's what we're kind of focused on for right now. So then on Wednesday, we're going to get the FOMC meeting minutes. On Thursday will be CPI, and then on Friday will be PPI, as well as consumer sentiment. And here's another look at the economic calendar. Seasonally, we're neutral to negative with the Dow, S&P, and NASDAQ for October 8th. And I switched this out for another chart here where we do see a little bit of negative seasonality, at least for the next few days during an election year for the S&P. Tuesday is kind of a flip of the coin, whether it's positive or negative based on what happened in 2023, but it is positive so far in 2024. And this is that window that we're looking at of October and then possibly even into November as far as weak seasonality, where we tend to see things weaker in September, even though September ended up holding up quite well. October can quite often be negative. So what's our warning signs for right now? The confirmed Hindenburg Omen and weak seasonality, but that's been here for a while. We're still watching it. We don't know if it's really going to lead to anything more than what's already happened. We're watching the defensive sectors, even though staples and utilities were weak. Energy was up, but that's more geopolitical. But healthcare has been holding up fairly well lately, too. We're keeping an eye on the growth to value ratios as well as discretionary to staples. And they're, other than the discretionary still holding up quite well, we're not all that encouraged by the growth to value, even though the growth to value ratio for the S&P is still showing some improvement. We're still negative with the S&P and NYSE McClellan oscillators, which then bleeds over into the summation indexes. The 10-day equity put call ratio is continuing to go down. And the Swenlin trading oscillator is now negative based on price and volume. The parabolic SAR is negative, and on a momentum basis, our S&P 500 oscillators, as well as the Copic curve, are, if they haven't already turned negative, the longer term ones are rolling over. The positive signs, we're still looking okay for right now with our smart money indicators, the accumulation distribution, the Chaikin money flow, and the Chaikin oscillator. The 5-day equity put call ratio is now back to going up. The advanced decline lines, we're still looking extreme with the bullish percent index, but now it's starting to come down. Where we're still looking positive with the NASDAQ 100 and NYSE bullish percent index. The vortex is positive. We'll have to see if that can show some more improvement. The money flow, ease of movement, and ultimate oscillators, even though they're declining, are still positive. And the momentum for the NASDAQ 100 is starting to turn negative, even though I'm keeping it on the positive side for right now until it decisively closes below its moving average. And the financial sector is still looking pretty good. So our conclusion, we're positive as measured by the moving averages, but we have this weak seasonality and confirmed Hindenburg Omen. And is weakness starting to come back in and rear its head again? It looked like it might be going away after Friday. Now it looks like it might be coming back. That's what we're watching in the short term and intermediate term, even though we're still positive since we're above the moving averages, and we still continue to be positive in the long term. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.